Welcome everyone. Today we're exploring a question many business owners ask. How much should you pay for bookkeeping? You're probably asking the wrong question. One of the most common questions business owners ask is, how much should bookkeeping cost? It's a reasonable question. Every business wants to control costs. Every owner wants value for money. But after working with business owners for more than 25 years, I've learned something important. The businesses asking only about price are often asking the wrong question. A better question is, what value should good bookkeeping create? Because bookkeeping isn't simply another monthly expense. When done properly, it becomes one of the most valuable management tools a business can have. Bookkeeping is more than data entry. Many people think bookkeeping is about recording transactions, categorizing expenses, reconciling bank accounts, preparing financial statements. Those responsibilities are essential. Without accurate bookkeeping, financial statements become unreliable, tax returns become more difficult, cash flow becomes harder to manage, business decisions become riskier. But accurate bookkeeping is only the foundation. The real value begins after the books are complete. Financial information should improve decisions. Good bookkeeping should answer questions such as, are we becoming more profitable? Why is cash flow tightening? Which services generate the highest margins? Which customers create the greatest value? Can we afford another employee? Is the business ready to expand? If bookkeeping cannot answer those questions, it isn't delivering its full value. Reliable financial information exists to improve decision making. That is where bookkeeping becomes a strategic business asset. Practical example. Number 1. Business situation. A restaurant owner paid a premium monthly bookkeeping fee believing higher cost automatically meant better service. Common challenge. The bookkeeping remained accurate, but management received very little financial insight beyond reconciled accounts and categorized transactions. Correct approach. The reporting process was redesigned to include monthly profitability reviews, cash flow analysis, and operational KPIs alongside the bookkeeping. Business lesson. Businesses benefit most when bookkeeping supports decisions, not simply compliance. Price doesn't always reflect value. Some businesses overpay, others underpay. Neither automatically receives better bookkeeping. The lowest price may create delayed reporting, poor communication, inaccurate records, weak financial visibility. The highest price may still deliver very little strategic guidance. The best value usually comes from finding someone who provides reliable bookkeeping, timely reporting, meaningful financial insight, proactive communication, ongoing advisory support. The objective isn't finding the cheapest provider, it's finding the provider who improves the business. Practical example number 2, business situation. A growing consulting business focused primarily on reducing bookkeeping costs. Common challenge, although monthly fees decreased, financial reports became inconsistent and management lost confidence in the numbers. Important business decisions were delayed because leadership questioned the accuracy of the information. Correct approach. The business selected a provider focused on reporting quality, financial visibility, and communication rather than price alone. Business lesson, reliable information often creates far greater value than small cost savings. Bookkeeping should support tax planning. Many business owners view bookkeeping and tax preparation as separate services. They're closely connected. Reliable bookkeeping creates the information required for proactive tax planning, compensation decisions, equipment purchases, financing, business expansion. Without accurate books, meaningful planning becomes difficult. Preparation supports compliance, reliable information supports strategy. Practical example. 3. Business situation. A business consistently completed bookkeeping only at year end. Common challenge? Most tax planning opportunities had already disappeared before discussions with the accountant began. Correct approach, monthly bookkeeping and quarterly financial reviews were introduced. Planning shifted from reactive to proactive. Business lesson, the greatest value of bookkeeping often comes long before the tax return is prepared. Financial clarity creates confidence. Business owners constantly make decisions involving hiring, pricing, financing, investments, technology, taxation. Reliable financial information reduces uncertainty. Reduced uncertainty improves confidence. Confident leaders make better decisions. That's why bookkeeping should never be measured only by price. Its greatest value lies in improving the quality of business decisions. Practical case study number 1. Business situation. A growing restaurant group outsourced bookkeeping to reduce costs. Challenge. Although bookkeeping remained accurate, management received only historical reports with little discussion about profitability, labor costs, or cash flow. Solution: monthly management reporting and quarterly advisory meetings were introduced alongside the bookkeeping. Outcome: leadership identified several operational improvements, strengthened cash flow, and improved profitability without significantly increasing revenue. Key lesson: bookkeeping becomes significantly more valuable when it supports management decisions rather than simply recording transactions. Practical case study number 2. Business situation. A professional services firm evaluated bookkeeping providers primarily on monthly fees. Challenge: leadership later realized the least expensive option created delayed reporting, inconsistent communication, and unreliable financial information. Solution: the firm selected a provider focused on timely reporting, proactive communication, financial clarity, and advisory support. Outcome: management confidence improved. Decision-making accelerated. The business recovered the additional cost through stronger operational performance. Key lesson: the true cost of bookkeeping is not the monthly fee. It's the quality of the financial decisions it supports. Common mistakes to avoid. 1. Choosing a bookkeeper based only on price. Many business owners compare bookkeeping providers the same way they compare office supplies. The lowest price wins. Unfortunately, bookkeeping isn't a commodity. Poor bookkeeping often creates inaccurate financial reports, missed tax planning opportunities, cash flow surprises, costly corrections. Avoid this by evaluating bookkeeping based on accuracy, reporting quality, communication, financial insight, and the ability to support better business decisions, not price alone. 2. Believing bookkeeping ends with financial statements. Many owners assume that once the books are reconciled, the work is complete. In reality, that's where the most valuable conversations should begin. Avoid this by reviewing financial statements every month and asking, what changed? Why did it change? What decision should we make because of it? 3. Waiting until year-end to review the numbers. Many businesses only discuss financial performance during tax season. By then, many opportunities have already disappeared. Avoid this by scheduling monthly financial reviews and quarterly planning meetings throughout the year. 4. Measuring success by revenue alone. Revenue may increase while profitability declines. Cash flow weakens. Margins shrink. Without meaningful financial reporting, those issues often remain hidden. Avoid this by reviewing gross profit, net profit, cash flow, accounts receivable, operating expenses, and KPIs every month. 5. Treating your accountant as a tax preparer instead of a business advisor. Many business owners contact their accountant only when tax returns are due. That limits the value they receive. Avoid this by building an ongoing advisory relationship focused on financial clarity, planning, profitability, forecasting, and strategic decision-making. Frequently asked questions. 1. How much should bookkeeping cost? There is no single correct price. The appropriate fee depends on transaction volume, business complexity, reporting requirements, payroll, and advisory needs. The better question is whether the service creates meaningful business value. 2. Should I choose the lowest priced provider? Not necessarily. Reliable bookkeeping often saves significantly more money through better decisions than the difference in monthly fees. 3. What should every bookkeeping service include? At minimum, accurate bookkeeping, monthly reconciliations, timely financial statements, proper transaction categorization, clear communication. Ideally, it should also provide meaningful financial reporting that supports better business decisions. 4. Why are monthly financial statements important? Because business decisions happen every month, not once each year. Timely reporting allows problems to be identified before they become expensive. 5. How often should bookkeeping be reviewed? Books should generally be updated continuously or monthly. Business owners should review financial performance every month and meet with their advisor quarterly. 6. Does good bookkeeping reduce taxes? Bookkeeping alone doesn't reduce taxes. However, accurate financial information allows proactive tax planning, which often creates tax-saving opportunities before year-end. 7. What's the difference between bookkeeping and advisory? Bookkeeping records transactions. Advisory helps business owners interpret financial information and make better decisions about profitability, cash flow, tax planning, and business growth. 8. What's the real return on investing in quality bookkeeping? Better decisions, better cash flow, better profitability, better planning, less financial uncertainty. Those benefits often exceed the bookkeeping fee many times over. Action plan immediate actions. Review what you're currently paying for bookkeeping. List the reports you actually receive each month. Ask yourself whether those reports help you make better business decisions. Next 30 days, review your bookkeeping process. Identify any reporting gaps. Schedule a meeting with your accountant to discuss cash flow, profitability, tax planning, and future business decisions, not just compliance. Long-term strategy. Build a bookkeeping system that supports financial clarity, develop monthly reporting and quarterly advisory meetings, evaluate bookkeeping providers based on business outcomes rather than monthly fees alone. Key takeaways. The cheapest bookkeeping isn't always the best value. Reliable bookkeeping should support better business decisions. Financial clarity matters more than reporting volume. Monthly financial reviews improve leadership confidence. Bookkeeping creates information. Advisory creates business value. Continue learning. If you found this article helpful, continue exploring these related topics. Good accountants fix problems. Great accountants prevent them. Learn why proactive financial guidance often creates more value than reactive compliance. Financial clarity. Why better decisions start with better information. Discover how reliable financial reporting becomes a management tool rather than simply a compliance requirement. Stop preparing tax information. Start building a better business. Understand why business owners create greater value through planning than administration. Tax and financial clarity assessment. Is your bookkeeping helping you build a better business or simply keeping your records organized? Complete the tax and financial clarity assessment to evaluate your financial reporting, cash flow visibility, profitability analysis, tax planning readiness, decision-making framework. Discover how reliable financial information can improve your business, not just your bookkeeping. Link in description.